What if I told you that holding SCHD alone might be costing you hundreds of thousands of dollars in missed gains? Now, before you click away thinking this is just another SCHD hit piece, hear me out. SCHD is an incredible ETF. It's one of the most beloved dividend funds in existence, and for good reason. But here's the uncomfortable truth that nobody wants to talk about. SCHD by itself is incomplete. It's like having a championship-caliber defense but no offense. You're protected, sure, but you're not winning the game. And in investing, the game is building wealth while generating income. So today, I'm going to show you exactly which two ETFs pair perfectly with SCHD to create either a high-growth income portfolio or a maximum income-generating machine. One is for those of you focused on long-term wealth accumulation. The other is for those who need serious income right now. By the end of this video, you'll know exactly which path is right for you, and more importantly, you'll understand why combining these funds could be the difference between a comfortable retirement and a truly wealthy one. Let's dive in. Quick favor, hit like and subscribe right now so YouTube shows this to more people who need to see it. Before we talk about what to add, we need to understand what SCHD actually gives us. As of October 2025, SCHD manages a massive $70 billion in assets. That's not a typo, $70 billion. This fund trades at around $27 per share and tracks the Dow Jones U.S. Dividend 100 Index. What makes SCHD special isn't just that it holds dividend-paying companies, it's that it screens for quality. SCHD only selects companies with strong cash flow relative to debt, high return on equity, consistent dividend yields, and 5 years of dividend growth. These aren't just any dividend payers, these are the best of the best. The fund currently yields 3.87% based on its 30-day SEC yield as of October 22nd. It pays quarterly dividends that have grown consistently from 17 cents per share in 2021 to 26 cents in 2025. And it does all of this for an expense ratio of just 0.06%. That's $6 per year for every $10,000 invested. It's almost free money management. Now let's look at what SCHD actually holds. The fund owns 103 stocks, and the top 10 tell you everything about its personality. Number 1 is AbbVie, the pharmaceutical giant, at 4.38%. Then you've got Cisco Systems, Amgen, Merck, PepsiCo, Coca-Cola, Lockheed Martin, Chevron, Altria, and Home Depot, rounding out the top 10. These are defensive, established, cash-generating machines. When you look at sector allocation, you see energy at 19%, consumer staples at 18.5%, healthcare at 16%, and industrials at 12%. These are the sectors that keep the economy running regardless of what's happening in the market. But here's where the plot thickens. Information technology, the sector that's been driving the entire market higher for years, represents only 8.3% of SCHD. Think about that. The sector responsible for artificial intelligence, cloud computing, semiconductor innovation, and the biggest wealth creation in modern history makes up less than 1/10 of this fund. This brings us to SCHD's performance, and this is where things get uncomfortable for SCHD-only investors. Year-to-date through September 2025, SCHD is up 2.84%. Not bad in isolation, but when you compare it to what's been happening in the broader market, it stings. The one-year return is barely positive at 0.56%. Meanwhile, the large value Morningstar category that SCHD belongs to is up over 11% year-to-date. Now don't get me wrong, the longer-term numbers are solid. 3-year annualized returns of 11%, 5-year returns over 12%, 10-year returns over 12%. SCHD is reliable. It's consistent. But it's leaving massive gains on the table during one of the greatest bull markets in growth stocks we've ever seen. And this is exactly why you need a complementary ETF. SCHD has 3 critical gaps. First, growth sector underexposure. With only 8% in tech, you're missing the AI revolution, the cloud computing expansion, the semiconductor boom. Second, capital appreciation limitations. SCHD's value orientation naturally caps its upside during bull markets. And third, yield trade-offs. While 3.87% is respectable, there are strategies that can nearly double that income without taking on crazy risk. So let's fix these gaps. First up, for those of you who want maximum growth while keeping that reliable dividend income, I present to you SCHG, the Schwab US Large Cap Growth ETF. This is the perfect growth complement to SCHD, and I'm going to show you why this combination is borderline genius. SCHG manages $51 billion and tracks the Dow Jones US Large Cap Growth Total Stock Market Index. Right off the bat, you're looking at companies selected for expected earnings growth, sales growth, and momentum. These are the companies building the future. The fund holds 197 stocks and yields just 0.34%, which sounds terrible until you understand what you're really buying. SCHG's expense ratio is even lower than SCHD at just 0.04%, $4 per year for every $10,000 invested. This is highway robbery in the best possible way. Now let's talk holdings, because this is where it gets exciting. The top holding in SCHG is NVIDIA at 11.1%. NVIDIA, the company that's become synonymous with artificial intelligence and has seen its stock absolutely explode. Second is Microsoft at 9.76%, then Apple at 9.67%. Broadcom, the semiconductor powerhouse, is fifth at 5.5%. Amazon, Tesla, Meta, and both classes of Alphabet stock round out the top 9. You're getting the Magnificent Seven, the companies that have driven the majority of market gains over the past few years. The sector allocation tells the whole story. Information technology represents 48% of SCHG, nearly half the fund. Communication services is 14%. Consumer discretionary, 13%. This is the complete opposite of SCHD's defensive positioning. Where SCHD zigs, SCHG zags. And here's the kicker, the part that makes this pairing absolutely perfect. SCHD and SCHG have 0% portfolio overlap by weight. 0. Every single dollar you invest is going to completely different companies. You're not paying duplicate fees for the same exposures. You're getting true diversification. But theory is nice. Let's talk about what SCHG actually delivers in performance, because these numbers are stunning. Year-to-date through September 2025, SCHG is up 14.84%. While SCHD is struggling at 2.84%, SCHG is crushing it. The one-year return is 23% compared to SCHD's barely positive return. The three-year annualized return is 32%. The 5-year annualized return is nearly 18%. Since inception in December 2009, this fund has returned almost 17% annualized. Let that sink in. If you had split your money 50-50 between SCHD and SCHG and rebalanced annually, a $10,000 initial investment would have grown to approximately $556,000 over the past 14 years. The S&P 500 over the same period would have gotten you to $534,000. You would have beaten the market by about 4% with a simple two-fund portfolio. But here's the beautiful part. This isn't just about growth. The blended portfolio would still give you about 2.1% dividend yield. That's 62% higher than the S&P 500's current 1.3% yield. You're getting better growth and more income than the market benchmark. Let me paint a picture for what this combination could do for a young investor. If you're in your 20s or 30s and you put $300 a month into a 50-50 SCHD/SCHG portfolio with an initial $2,000 investment, and assuming historical return patterns continue, you could realistically be looking at $1 million in 25 to 30 years with reinvested dividends. That's the power of combining dividend quality with growth exposure. That's the power of not leaving massive gains on the table while still collecting reliable income. Now, I need to be honest about the risks, because I'm not here to sell you a fairy tale. SCHG is more volatile than SCHD. The 3-year standard deviation is 16.34% compared to SCHD's 14.5%. When tech stocks get hit, And they will eventually, SCHD will feel it more. The fund is heavily concentrated in mega-cap technology companies with a weighted average market cap of nearly $1.9 trillion. More than half the fund is essentially the Magnificent Seven stocks. If those companies stumble, SCHD stumbles. And valuation matters. SCHD's price-to-earnings ratio sits at 39.24 with a price-to-book ratio over 10. These are rich valuations. If growth expectations moderate or interest rates spike, these multiples could compress, and that would hurt returns. But here's my take. For long-term investors with a 10-plus year time horizon who can stomach volatility, the SCHD plus SCHG combination is one of the smartest two-fund portfolios you can build. You get defensive dividend quality, you get aggressive growth exposure, you get minimal overlap, and you get rock-bottom fees. But now, let's talk about the other path, because not everyone is optimizing for long-term total return. Some of you watching this need income now. Maybe you're retired or approaching retirement. Maybe you're building passive income streams to replace your job. Maybe you just want to see serious cash flow hitting your account every month. If that's you, forget SCHG. Your perfect SCHD complement is JEPI, the JP Morgan Equity Premium Income ETF. And this thing is an income-generating machine. JEPI manages $41 billion and trades around $57 per share. But what makes JEPI completely different from traditional ETFs is its dual strategy approach. The fund is actively managed, which normally I'd tell you to avoid because of high fees and underperformance, but JEPI is different. Here's how it works. 80 to 90% of the fund is invested in a defensive portfolio of about 126 large-cap U.S. stocks selected through fundamental research. These are quality companies with strong risk-adjusted characteristics. But the remaining 10 to 20%, this is where the magic happens. JEPI systematically writes out-of-the-money call options on the S&P 500 index. They're essentially selling insurance to other investors, collecting premium income in exchange for capping some upside. This is called a covered call strategy, and when done well, it generates serious income, especially during volatile markets. So, what does this income actually look like? Hold on to your seats. JEPI's 30-day SEC yield as of September 30th is 7.17%. The 12-month rolling dividend yield is 8.32%. Think about what that means. On a $50,000 investment, you're looking at over $4,000 per year in dividend income. And unlike SCHD's quarterly payments, JEPI pays monthly. Every single month, cash hits your account. Recent monthly dividends have been around 36 to 40 cents per share, which translates to roughly $4.30 to $4.80 annually per share. The expense ratio is higher at 0.35% because this is actively managed, but when you're generating 7 to 8% yields, that fee becomes almost irrelevant. Let's look at what JEPI actually holds. The top 10 holdings include Alphabet, AbbVie, Nvidia, Microsoft, MasterCard, Johnson & Johnson, Meta, Ross Stores, Amazon, and Visa. These aren't risky, high-yield traps. These are quality large caps. The sector allocation is beautifully balanced. 15% information technology, 12% each in financials, healthcare, and industrials. Then consumer discretionary, consumer staples, communication services, utilities, real estate, energy, and materials. But remember, roughly 15% of the portfolio is in options and equity-linked notes, and that's what's generating the premium income that drives those monster yields. Now let's talk performance, because this is where JEPI's trade-offs become clear. Year to date through September, JEPI is up 5%. The one-year return is 4.32%. 3-year annualized returns are about 13%, and 5-year returns are 10.62%. These are not SCHG numbers. You're not getting 23% annual returns. But here's the thing, you're not supposed to. JEPI isn't designed for maximum capital appreciation. It's designed for maximum income with equity exposure. And compared to traditional fixed income alternatives, JEPI crushes them. The ICE Bank of America 3-month Treasury Bill Index returned only 4.38% over the past year. JEPI matched that while providing equity upside potential and significantly higher income. So what happens when you combine SCHD and JEPI? You create an absolute income powerhouse. A 50-50 allocation between these two funds gives you a blended yield of roughly 5.5 to 6%. Let me repeat that. 5.5 to 6%. That's more than 4 times the S&P 500's yield. On a $100,000 portfolio, you're generating $5,500 to $6,000 per year in dividend income. For retirees or anyone needing substantial current cash flow, this combination is incredible. You're getting SCHD's quality dividend growth stocks combined with JEPI's options premium income, and you're collecting checks every month from JEPI and every quarter from SCHD. The cash flow is consistent and substantial. But let's talk about the trade-offs because I want you to make an informed decision. Since JEPI's inception in May 2020, SCHD has outperformed in total return. A $10,000 investment in SCHD would have grown to about $15,292 by October 2025, while JEPI would have reached $14,350. SCHD wins on total return. But during market volatility, JEPI shows its defensive strengths. During the correction ending September 2022, GP's worst drawdown was 18.27%, while SCHD dropped 21.67%. JEPI's covered call strategy provides a volatility cushion. The premium income collected acts as a buffer during downturns. However, and this is critical, during strong bull markets, JEPI will lag significantly. The covered calls cap upside participation. In explosive rally years, you'll watch growth stocks double while JEPI grinds out mid-single-digit returns. That's the price you pay for the high income and lower volatility. Also, JEPI's distributions are tax inefficient compared to SCHD and SCHG. The monthly payments include a mix of qualified dividends, non-qualified dividends, and return of capital, which creates more complex tax reporting. For taxable accounts, this matters. For IRAs and 401ks where taxes are deferred, it's irrelevant. So now, you're probably asking, which one should I actually choose? SCHG or JEPI? And the answer is, it depends entirely on your situation and goals. Let me make this really simple. Choose SCHG if your time horizon is 10 plus years. Choose SCHG if total return is your priority and you want to maximize long-term wealth. Choose SCHG if you want growth sector exposure to participate in technology innovation. Choose SCHG if tax efficiency matters because you're investing in a taxable brokerage account. Choose SCHG if you want the absolute lowest costs with that 0.04% expense ratio. On the flip side, choose JEPI if you need current income and monthly cash flow right now. Choose JEPI if you're in or near retirement and shifting from accumulation to distribution phase. Choose JEPI if you prefer lower volatility and are willing to accept capped upside for that stability. Choose JEPI if you're building a portfolio specifically designed to replace employment income or supplement retirement. Choose JEPI if you're in a tax-advantaged account where distribution tax treatment doesn't matter. Let me bring this home. SCHD is an incredible foundation, but by itself, it's incomplete. It's too defensive, too value-oriented, and too light on growth sectors to be a standalone solution in today's market environment. By pairing SCHD with either SCHG or JEPI, or even using all three in a balanced approach, you're building a portfolio optimized for your specific goals. If you want long-term wealth accumulation with solid income, SCHD plus SCHG gives you that with zero overlap, rock-bottom fees, and proven outperformance versus the S&P 500. If you want maximum current income with equity exposure, SCHD plus JEPI delivers 5 to 6% yields with monthly cash flow and defensive characteristics. Both strategies are exponentially better than SCHD alone. The best investment strategy is the one you'll actually stick with through market ups and downs. So here's what I want you to do. Look at your situation honestly. What's your time horizon? What are your income needs? What's your risk tolerance? Then choose your path. Start with whatever allocation makes sense for you, even if it's just $50 per month. The key is starting and staying consistent. The magic isn't in perfect timing or finding some secret ETF nobody knows about. The magic is in combining complementary strategies, keeping costs low, reinvesting dividends, and letting compound returns do the heavy lifting over decades. That's how you build real wealth. So drop a comment below and tell me, are you Team SCHD for growth or Team JEPI for income? And if you found this breakdown valuable, smash that like button and subscribe because I break down investment strategies like this every week. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.